Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 7th. I'm Eric Wilkinson, and some of you may very well recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, how that comes in to impact the markets with some of my market analysis. So obviously we've got a lot to talk about today then, huh? But without further ado, let's get on with the economic data. Across the pond, we got German factory orders coming in at 2.3%, expected to be a pullback negative 0.6%, and a nice revision to last month's number to 3.3%. Great Britain PMI, construction PMI coming in at 54.6, and that was right in line with expectations there. Flash estimates coming out of the European region for flash estimates coming out of the CPI out of the European region coming in at negative 0.3%, expected to be negative 0.2%. So pretty close to being in line there, taking core CPI, which is going to strip out food and energy, in line with expectations at 0.2% there. Then we can talk about retail sales out of Europe. Those came in worse as well, negative 6.1%, expected to be a negative 3.4%, and a revision to last month's number down to 1.4%. Not good at all. And then we can move back over here to the United States and talk about our unemployment claims. These are the weekly unemployment claims. It gives us pretty good representation if you keep track of it for what's going to happen with the non-farm payroll. So I think it's very important. 787,000, that was lower than the expected 798,000. So good to see. It seems like people were getting employed there. That should help the overall economy, especially with more lockdowns that we're seeing. Institute for Supply Management. This is our main PMI number. This is Purchasing Managers Index. Anything above 50 is expansion. Anything below 50 is contraction. And we are a service sector, so we have to look at this number forward looking. And it came in at 57.2, expected to be 54.5. So nice to see that that is moving higher there. As a matter of fact, it is in line with what we're seeing, but great to see that explosion there. We were supposed to see some of that pullback. Why? Because of the newer lockdowns in and around the United States. Finally, we got natural gas storages, a drawdown of 130 billion cubic feet, expected to be 142 billion cubic feet. All right, IBM, I have pulled this chart up because right before I was going on here, as a matter of fact, all day yesterday, I decided when we came up close to this 132, 133 area and started failing into the end of the day, I started chasing on my covered calls on the IBM. So it's continued again today. I thought I had a good spot to sell some 133 calls in there to cover my longs in IBM, and I moved it down to 132 and 32. I was thinking 131, but I haven't gone that far as of yet. I wanted to be above this Fibonacci line, which was my ultimate goal, selling the 133s, and then I gave in a little bit. So I'm done chasing that. It's not really working out. So let's talk about one other thing, is the geopolitical environment. We didn't talk about that. So we do need to talk about that as in regards to how this is affecting the markets. So let's take a look at the overall markets here. All right. So yes, unrest at the Capitol, all of that stuff is something we need to talk about. One thing I always say when we were on the floor, trading options is like golf. You have to play the course. All right. You're not playing the guy next to you or anything else. You're playing the course to win or to lower your overall score, right? And options are absolutely the same way. And trading is that same way, right? Volatility is actually our friend in this whole arena. The wilder anything is happening is the time that traders actually have some of their best trading happening because of that volatility. And that's the other side of the coin of everything, right? But the fact of the matter is we need to play the course here. And what that means is we need to keep our eyes on what's going on, but really it's a lot of noise, and we need to take advantage of that by with volatility and being smart about the options trades that we're doing, okay? So without that being said, let's just go on to the overall markets and see how they're reacting to that unrest, because that's really what we need to pay attention to, is what the overall markets are feeling, okay? We need to keep an eye on the noise, but how is that really affecting the markets? And that's what I mean by we're playing the course, all right? So let's get on with it. Crude oil up into those 50s. You know, I could talk about this till I'm blue in the face, but we won't go into it. You guys know my feelings on this as it is being high, elevating into that 50 handle, causing basically gas to go up around $2.50 a gallon, which is kind of about 50 cents higher than what we were seeing earlier on during the pandemic, right? Which, you know, I've talked about that, how it slows velocity of money when that happens, okay? Gold futures coming right back to the point of control, trying to hold on to that, you know, 1900 handle. That is really the psychological level. We all also have to keep in mind our old historical high that, you know, held on for like 10 years, that 1923 area. That's not going to leave anybody's minds anytime soon. So we need to keep our eyes on that as well. Today opened up kind of right around that area and have started to slide. We are finding support right here on this 9-day simple moving average. That is key for short-term bullish moves. And if we stay above that, that will signal that we're just making a bit of a correction here on this upward stepping trend channel here. As we can see, we have higher highs and higher lows, which is indicative of, you know, a stronger move there. Now, some chartists would say you do that 5 times and then you look for like a correction. So off of a corrected move and then look for that pattern. So that is a nice move to the upside. You know, I would not be surprised if we start seeing this market make some more moves to the upside as well. I haven't put anything on with that. Bonds continue to break my heart. No, down almost another point today. Interest rates are going higher. That is going to be something we are going to have to keep an eye on. Play the course, Wolfman, right? That means we need to keep an eye on the housing industry, all right? Is it a time to start looking at the housing industry as being a little frothy as these interest rates go up? The bottom line is, we talk about this real quick. These things are all very, very correlated. And yes, Lisa, I'm still playing around with the light here. It's a little, you know, I'm working on it. But, it's kind of hard. You guys got to understand, I live with a interior designer, so blowing up my entire office is kind of treading on thin ice. All right, so anyway, what we're talking about here is the bonds going higher. So the idea here is, we talk about this, if some of you guys are newer, it's a teeter-totter, right? As the bonds go down, right? As bonds go down, we'll just call that the dollar, right? The bonds go down, we see interest rates go up, all right? And what happens when you see interest rates go up? Interest rates go up over here, and these are basically very correlated too. As interest rates go up, and we do the teeter-totter, this is your home price. All right, so I'll change that to bonds. All right. So as bonds go down, basically interest rates go up. If interest rates go up, the home price goes down, because basically the idea is that you can't afford that same size house, so therefore the prices start coming down a little bit there. All right, and with, the one thing I forgot to talk about was even copper. Basically, all of the inputs to a home, those prices are very elevated right now, so the cost to build a new home is expensive as well, and that has to do with a lot of this demand. So could we start seeing these prices of like copper, lumber, start to come off a little bit here? All right, moving on. Bonds, they're the bonds, right? So VIX coming off a little bit here. If we're seeing the bonds come off like that, and we're seeing then probably equities start to move higher here. And as you can see, I have this broken down on the 15-minute chart. Overnight, all of the unrest really didn't affect the markets whatsoever. The moves today to the upside were very strong as people were putting money to work here, consolidating a little bit here. And I do believe that this isn't going to really affect this upside momentum we're seeing here in the equities. And I think that with the stimulus checks, that's going to spur this economy a little bit more, create that velocity of money that we need to see in a slowing economy. That's the best way to do that. Also, the problem is you start getting the interest rates start to rise, right? And that is something that would encourage people to save money, as you can get a return on your investment by saving it. Now, we're not quite at that point right now. The interest rates are really suppressed, but that's the idea. Interest rates rise to get people to start saving. All right, the NASDAQ is moving higher by almost 300 points here on the day, looking to take this as an inside high. We haven't had that yet. That was an overnight, if you guys remember. So I've always talked about this. The day session always wants to print the overnight sessions before moving along there. All right, and E-mini S&Ps continue their strength to the upside. Tesla is going to be very touted in the E-mini S&Ps. They could start keeping up to the upside with Tesla now at this point. Or with Tesla in there, to the NASDAQ moves a lot of time when you're talking tech. They are an automobile company, but really they're, the idea is their value is in their tech. All right, E-mini S&P is moving higher by 54 points here. You can see very strong into today. No reason why not to think that ISM, Institute for Supply Management Services, PMI, which is Purchasing Managers Index. Remember, that is very forward looking. The purchasing manager looks at the economy and sees how that is affecting their sales, and therefore they have to buy in advance of the demand, right? And that is why we really love that particular data point. My favorite by far. Fun fact, it used to be called the NAPALM, which was like the National Association of Manufacturers, something or other. I can't even remember it. But that was old school, and they changed it to the ISM. All right, anyway, that's all I've got for you. We talked about my IBM trade. I'm not going to chase it anymore. I was going to try and get a little cheeky and just say, hey, why do I really want this in my portfolio, especially rolling the dice going into, we might as well talk about IBM. Let's just pull it up if I've got there. Going into this earnings. I mean, I am long this, and we can see going into the earnings, and that's why I decided to do those, sell some calls right up in this area somewhere in here, right? Because you can see on their earnings, despite the fact that I think what they're doing going to the cloud services and stuff like that, especially at a stay-at-home economy, that's a high profit margin sector of their business. And the street doesn't have a love for that with IBM. They consider them more of a service type of company. But at the end of the day, so that's what made me started thinking about it. Why even take the pain on it? If I get those called away from me, then I can easily, when I go in there and play their earnings, sell some puts and maybe get them back. So at a nice level, right? That's why I'm chasing that. Hopefully I do get those called away now. I'm going to leave it working, but I'm going to stop chasing it all the way down. It is ultimately where I'm at right now. So that's all I got for you guys. Please take a moment to go over our disclaimer. It is important to understand your risk when trading anything. So take a moment to go over our disclaimer, and even if you have to pause it. All right. So we'll see you this afternoon in the webinar. We're going to be doing it on the ratio call spread or the front ratio spread. So check that out. We have specific guidelines that we're using to go along that, just like when we're playing golf, right? If there is a hazard, do we need to lay up or something along those lines? Or do we go for it, all right? So we'll talk about that in the upcoming course. But on this one, check us out because we're doing the roadmap to trading options. That's a great one as well. It's, if you're planning a trip, how do you manage what's going on in that environment you're going to be in? All right, so that's all I got for you guys. Have a great one. If you can't take that, take it easy.